Hey everyone, and welcome back to another video for today. So we're going to talk about another fintech company, one that has gone public earlier this year. Of course, it's not SoFi, but SoFi is of course my favorite fintech player. And so in order for me to add a new fintech player in the portfolio, it really has to be a very good one. For those that are unaware, SoFi is worth $31.7 billion. Over the past 3 years, stock is up 313%. Over the past 12 months, the stock is up 255%, and year to date, it's up 87.4%. Is it still a buy? Is it worth holding? The answer to me is yes and yes. Now, before jumping into Chime, because that's the company we do want to cover in this video, it's a company that did go public earlier this year, and it's a company where its stock has gone down close to 50% from the first day it went public. I would like to quickly touch on the opportunity cost aspect. Now, I don't know if you remember, but SoFi, yes, even with SoFi, we've had this BS excuse of opportunity cost, right? It's been opportunity cost here for 441 days. Then it went a little bit higher, but also for 469 days, it's been opportunity cost. And now that we are close to all-time highs, if not all-time highs, it's, maybe it was just an opportunity. Maybe it was an opportunity for long-term investors to accumulate an insane amount of shares. And I think most SoFi bulls did enjoy buying more and more SoFi shares, $6, $7, $8, $9, $10, $11, $12 over that period of time. Why is that? Well, because now you have an insane amount of shares with a very low cost average, and you've more than doubled, maybe even tripled your investment. And that's why every time I hear, but opportunity cost is something you use after the fact. Unless, of course, it's about a company where the industry is completely changing and you would rather wait to see how that affects the company, then that's fine. But all the rest is always about hindsight. It's opportunity cost because it didn't move and something else did move. Well, if we knew which stocks would move more than the others, I think we would all pick the same stocks, right? But we don't know because we don't have a crystal ball. And so, with that said, let's go and touch on Chime Financial. Now, Chime right now is worth $8.7 billion. One share will cost you under $24. Now, what I did find extremely interesting is the following. I went to Google Trends to see how popular Chime and SoFi are in the United States based, of course, on Google Trends. And over the past 12 months, you can clearly see that interest over time, Chime is the blue line and SoFi is the red line. I didn't know that Chime was so popular in the United States. Apparently it is. Then if you look at the last 5 years, same thing here, Chime is blue, SoFi here is red. We've seen, of course, SoFi grow over time, but here as well, I am quite impressed at how popular Chime is. If we look at the breakdown by sub-region, of course, California SoFi is beating Chime probably because of the SoFi Stadium, but Chime is doing quite a good job in the rest of the United States. But that might change because as of last quarter, Chime raised unaided brand awareness from 30% to 40% in the last 2 years, now rivaling the 2 largest US banks among those that make up to $100,000 per year. Now, SoFi's unaided brand awareness sits at 8.5% as of last quarter, so still a long way to go. But looking at SoFi's size today, and then looking at the unaided brand awareness, imagine how big SoFi as a company it's going to be when we are going to reach these types of levels. Quite insane. Now, before continuing, if you enjoy this type of videos, hit all the buttons. And if you are in the United States, are you using Chime? Are you using SoFi? Have you heard of Chime or SoFi? Let me know down in the comment section below. Hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So Chime is a mobile-first fintech platform offering fee-free banking services such as checking, savings, early paycheck access, and overdraft protection via partnerships with FDIC-insured banks. Yes, there are a lot of similarities between Chime and SoFi. Now, if we're looking at Chime as a business revenue-wise, this is what it has done over the last couple of years. Last 12 months revenue sits at $1.94 billion. 3 years ago, that was at $1 billion, and it's still expected to grow 28.3% in fiscal 25, 21.5% in fiscal 26, and 17.8% in fiscal 27 to reach just over $3 billion in revenue. SoFi, by then, analysts do expect them to generate around $5 billion in revenue. And right now, SoFi sits at just over $3 billion. Now, looking at Chime's active member growth, we can see that since the March quarter of 2022, it has grown that at a compound annual growth rate of 20.8%, and last quarter that did increase 22.5% year over year to 8.7 million. If we look and compare that to SoFi's growth of members, well, since Q1 2022, SoFi's growth has compounded at a 40.7% clip, whereas Chime sits at 20.8%. Looking at the average revenue per active member for Chime, that did increase 12.4% year over year last quarter. And then, if we look at their latest earnings report, we saw the following thing. Active members up 23% year over year, purchase volume up 18%, average revenue per active members up 12%. Revenue is up 37% year over year, gross profit up 38% year over year, transaction profit at 21% year over year, which is 69% margin. And by the way, gross profit margin sits at 87%, adjusted EBITDA margin at 3%, and adjusted EBITDA was actually up 417% year over year. Looking at non-GAAP OPEX or operating expenses as a percent of total revenue, that improved 11 percentage points year over year with leverage across each expense category. So a year ago, that was 78%, we're now at 66%. As for the guidance for Q3 and for full year 2025, they expect revenue for Q3 to grow between 24 to 27% year over year and reach an adjusted EBITDA margin of 2 to 3%. As for the full year, that adjusted EBITDA margin should reach 4%, and year over year growth for revenue should be between 28 and 29% to reach $2.13 to $2.15 billion. Now, more recently, Chime did attend a couple of analyst conferences, the most recent one here at the Goldman Sachs one, and they said the following thing. Average revenue per active member for members utilizing 6 or more products approaches $500. The lifetime value to customer acquisition cost ratio is approximately 7 to 8 times. The payback period on the customer acquisition cost has recently improved to 5 to 6 quarters, and MyPay product has achieved an annual revenue run rate exceeding $300 million. The MyPay product is basically you being able to get up to $500 earlier on your paycheck. They also said that the MyPay loss ratio improved from 1.6% to 1.4% last quarter. Approximately 50% of new member enrollments originate from organic referrals and word of mouth. Primary account members exhibit a 90% retention rate after the first year, and net dollar retention for cohorts is over 100%, indicating expanding relationships. They do also have a competing product, very similar product to SoFi at work, called here Chime Enterprise. So Chime is actively developing an enterprise channel through partnerships with employers like Ubiquiti, eTech, and Workday. This offers employees enhanced benefits such as 100% of their paycheck on demand for free, and is showing strong early adoption and re-engagement, positioning it as a significant growth driver for direct depositors in the future. Artificial intelligence is being embedded across all aspects of Chime's business, from internal operations and product development to customer support, where 72% of interactions are now handled by AI with higher satisfaction. Longer term, AI is envisioned to create personalized financial advisory experiences for members, leveraging Chime's unique data set. Going back to the Chime Enterprise, they said that the Chime Enterprise channel is not expected to have a significant impact on growth this year due to the nature of enterprise deals. It is anticipated to become an increasingly important channel for member acquisition and direct deposits starting next year. The company also sees substantial runway for continued average revenue per active member growth, which it intends to pursue in a manner aligned with member value. At the Deutsche Bank analyst conference, they said the following thing: Chime's performance is driven by a strategic focus on serving financially underserved populations, specifically 200 million US adults making up to 100,000 annually, a segment often overlooked by traditional banks. The company employs a digital disrupt playbook, emphasizing a radically innovative cost structure that allows it to offer superior value at the lowest market cost, leading to exceptional customer engagement with active members transacting 55 times per month. A key differentiator is its success in securing primary account relationships, which act as a business flywheel, generating highly recurring non-discretionary spend and robust unit economics. Chime maintains significant structural advantages over incumbent banks, including a cost to serve estimate at 1/3 to 1/5 of traditional institutions, a business model monetizing at nearly 70% transaction margin, we know it's 69%, and a product innovation strategy tailored to liquidity and credit building for its target demographic. This, combined with strong brand recognition, enables Chime to accelerate member growth while simultaneously improving unit economics. Now, for those wondering, currently the analysts are not expecting this company to become profitable anytime soon. And so right now, if we look at the stock, like I said, when it went public back in June, the stock peaked here at around $45 or so, which means it's down 47% since the peak on that day. Stock now is very, very close to being oversold. It's been going down relentlessly since the end of July. Now, why am I making this video if it sounds like I'm extremely bearish on this business? Well, I am not. I actually think it's quite a good business. I actually think there is quite a lot of upside here, especially now that we're back to normal levels, right? This here is the IPO hype. Never buy the hype unless it's a DPO, then maybe we can discuss that. But this is much better, down 47%. Valuation-wise, pricing-wise, it makes a lot more sense. The business is growing, the business is doing what it should be doing. Of course, when we compare it to a SoFi, you have to be much, much better. And is it better than SoFi? No, I don't think so. But is it a good opportunity? I think you might find these levels quite attractive if you were looking to buy Chime. Patience, of course, here is the name of the game, and those that have been waiting, I think now there is an opening here. I will not be buying this stock because, like I said, I have enough fintech players, and to get into the portfolio, you need to be much better than the current fintech players that I have, and there are others that are, of course, higher on that list, new holdings being one of them. So that's about it for me in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I see you all in the next one. Bye-bye.